So the next slide we'll have number 12. And on number 12, we'll go ahead and we'll do a sales mix calculation. Let me scroll this up. So number 12, we're going to selection of a sales mix. Excel Memory Company can sell all units of computer memory X and Y that it can produce. So no matter how many they're going to be able to produce, they're going to be able to sell them all. It has limited production capacity. It can produce 2 units of X per hour or 3 units of Y per hour, and it has 4,000 production hours available. Contribution margin is $5 for X and $4 for Y. What is the most profitable? What is the most profitable sales mix for this company? So if we look at this, we're going to first get the contribution per unit. Contribution again is sales minus variable costs. So our contribution margin for X is $5, Y $4. These amounts are given down here. I'll highlight it so you guys can follow along. And then what you're going to do next is you're going to do your production hours per unit. So that means an hour has 60 minutes, not 100 minutes, it has 60 minutes. And here it tells us that for product X, they can do 2 units of X per hour. So that basically means it takes half an hour to do 1 unit of X, right? Or if you take 2 and divide it into 60 minutes, you'll get 30 minutes, which is half an hour. Now, Y, on the other hand, you can do 3 units. So 3 into 60, that's 20 minutes. 20 minutes is 1/3 of an hour. And we have that information. So what we're going to do next is we want to take the 1/2 and figure out the contribution margin per hour as it relates to product X. And the only way to do that is to take the 5 divided by the amount of time it takes. So that means that if you had a whole hour, you could contribute $10 to the bottom line if you produce your X product, because you were able to do 2 per hour. And that makes sense, because if you have $5 per unit and you can do 2 units in an hour, you're looking at what, $10. So that's 1/2 divided into 5 gives us 10. And we're going to do the same formula over here. We're going to take the $4 per unit, and then we're going to divide that. We're going to divide that by the 1/3, and we come up with $12 per hour. So that means if you have 1 hour, would you rather get $10 or would you rather get $12? You have to decide between those two. Well, I'd rather have the $12. So which yields a higher CM per hour? It would be product Y. Even though we have to do 3 of them, we can do 3 of them in 1 hour. And fix that. Okay, and that's it for the sales mix. Now the next item, we're going to look at elimination, and that's question 13. Let me see if I can make it a little bit smaller. So question 13, let's go down to question 13. A guitar manufacturer is considering eliminating its electric guitar division. So we're thinking about getting rid of this guitar business. So we're going to look at our costs as it relates. Here goes some charts, and so we have this information here, and it says that the division, because it's 76,000 expenses are higher than its 72,000 sales. The company reports the following expenses for the division. Should they eliminate it? Well, looking at first glance, you're seeing, oh my goodness, I'm at a loss. 76 for the expenses, where the sales are only 72, so I'm losing $4,000. Let's see if I should actually eliminate it. So what we'll do is we'll look at a comparison between our avoidable and unavoidable expenses. Now, if we were to eliminate it, we could avoid doing the cost or incurring the cost for cost of goods sold for these units that we're selling. So we could actually get rid of cost of goods sold of $56,000 if we decide to eliminate this guitar unit. And in addition to that, we have some direct costs that we can also get rid of. And again, these terms were discussed in Chapter 22. And then our indirect expenses of $470 we could actually avoid by not having this segment. And then our service department costs of $6,000 could also be avoided. And we'll just add those up, equals sum of all of our costs, our expenses, and I get $71,720 that could be avoided. Now the costs that cannot be avoided, well, there's none related to cost of goods sold because they're all avoidable, so let's go ahead and put 0 here. It's given to us. And then we have $1,250, which are direct expenses, meaning they're going to remain no matter what we do. And then $1,600 will remain as well, and the service department had $1,430 that will remain. And we'll add it up, equals sum. So if we got rid of this guitar line, we could get rid of $71,720, but we would only have $4,200 that are still going to remain. So we're still going to have that additional expenses. So we're looking at a loss of $4,280 if we get rid of it. Now on the flip side, we were able to have, what was it? 72,000. So that was equal to 72,000 originally, minus the 76,000. Oops, I did it wrong. Missing a 0. Okay, and you'll see that originally we had a loss of 4,000, but if we get rid of it, we're still going to have a loss of 4,280. So we're actually going to lose $280 more by getting rid of it. Another way to look at this is that you're looking at your avoidable expenses of $71,720. So of the $76,000 in expenses, you're only able to avoid you're going to be able to avoid $71,020. And when you look at your revenue of your revenue of $72,000 in sales and your expenses of $76,000, you don't want to do this because, oh my goodness, I'm going to be losing $280 more just by getting rid of it. So you got to find another way to come up with some additional revenue to cover that additional loss if you want to eliminate it. So our answer is should, let me see, not eliminate. And another way to look at it is you're losing out on the $72,000 of sales, and you can only get rid of $71,720 of those expenses. So there's still going to be some other expenses in that $76,000. Alrighty, of $4,200. So this is the last one that we're going to do is the keep it or replace it. Think of this as, should I keep my car or should I get a brand new car and replace it with a new car or another used car that's better than my existing car? So using the incremental, we're looking at this concept to replace a machine. So let's scroll down to item, was it 15? Okay, we're on 15. This is the last one. And again, you can always pause this video, come back to it later, or just use it as a reference when you're doing your homework. So the next item you'll see is Quick Study 23-15. You have Rory Company has a machine with a book value of $75,000. Book value is considered sunk cost, spilt milk, and a remaining 5-year useful life. A new machine is available at a cost of $112,500, and Rory can also receive $60,000 for trading in the old machine. The new machine will reduce variable manufacturing costs by $13,000 per year. Now make sure you read this very carefully on your tests and your homework, what period of time you're talking about the savings. And it's over a 5-year useful life, should the machine be replaced. So what we're going to do is we're going to see if we should replace it. So the cost to buy the new machine is going to require money on our part. So that's $112,000 that we're going to have to pay out. So I'm putting it as a negative, and then you're going to double click between the B and C to make it wide enough to hold the widest thing. So just double click here and I'll make it wide enough automatically. Then the cash received. So if we trade it in, we're going to have to purchase a new machine, and we're going to get another $60,000 for trading in the old machine. So we got to include that in our decision. And since we're going to receive it, that's going to be a positive number, $60,000. And then when you look at the reduction in variable manufacturing costs, this is how much money we're saving. So when we look at what we're saving, it says $13,000 per year over 5 years. So if we are saving the money, this is a positive number to us. So we're going to take the 5 years times the $13,000. So over the 5 years, we're saving $65,000. And now I'm going to just add them up. Equal sum. Now we get $12,500. That's the net incremental additional income. So since we're going to get more, we should replace the machine. All right. So that's it. And again, we have the terms at the bottom. Hopefully you'll go through in the PowerPoint video and write down what these terms mean. And since we were unable to do this as a group project, we just went through step by step. And if you prefer, you could actually have done this on paper. You didn't have to actually do it on Excel. If you chose not to, you could do it manually as well. So this concludes this video. And remember, today is a great day to learn accounting.